Hello, this is Eric Boyce, CEO and Chief Investment Officer for Boyce & Associates Wealth Consulting, and welcome to Charts and Chat for December 4th of 2023. So the first chart of the week we're going to get to is going to be the GDP revision from last week. That is economic growth for the third quarter. So as most of you probably already know from listening to us for a while, that you have an initial release and then you generally have 2 to 3 revisions on that. And so this is basically a revision, which was a little bit higher than the initial reading. So 5.2, as you can see here on the left-hand side, you can see the trend line here was slightly down over a number of quarters, and then we had a really, really strong quarter. You can see the components of that, revisions from the initial report. So we had an uptick in both government spending and business spending, as well as inventories and housing. And inventories is an interesting note here, too, because consumer spending has been fairly strong. And so you tend to have inventory replenishing when consumer spending is strong, and not only at the consumer, but also the producer level. And so but right now, we saw in that latest revision that consumer spending was, although it was still strong in the aggregate, it was weaker than in the initial report. So in essence, the spending number was revised down. So it'll be interesting to see, the continuation of this. We do feel like government spending is probably going to slow down. Obviously, we've got a lot of issues on Capitol Hill. We've got an election coming up next year, which I think there's be a lot of positioning and what have you there. And so I do think government spending is going to grind to a slow halt, and we're still going to have budget discussions, et cetera. And then housing, we know, is going to continue at a fairly anemic pace. And then business investment is based on the surveys that we see, based on the data that we're acknowledging, we really don't expect a lot of business investment. So when we get back to this number and said, this is terrific, we should celebrate 5.2%, but the trend line is probably going to fall in line somewhere around here over the next several quarters until we hit a new market cycle. And then we can kind of talk about what those numbers are going to look like. On this slide, we have the contribution to real GDP on the left-hand side. And so what we're looking at here on a trend line basis, and obviously the number that was reported, again, fairly strong. You can see inventories, still account for a pretty strong amount of that. And then as we saw on that last slide, consumer spending in the aggregate is pretty strong. So this is, in the last slide, we showed you the change from the initial report, and that's why when you looked at that consumer spending, it looked somewhat weak. Well, in the aggregate, consumer spending is actually still strong. It's just the second reading, it was weaker than it was in that first reading, but it's still strong. Government spending, just like we said, so again, there's several of these components that are going to compress here, and we feel like consumer spending is going to look maybe a little bit more like this over here than what we have here. And then obviously inventories, which are very volatile. You can have wide swings in inventory contributions or contractions depending on where you are in the cycle and what essentially business sentiment looks like. If you feel like things are going to slow down, you're going to tend to not want to produce as much, and that number is going to be slower in terms of growth and lower in terms of the actual number. But again, I think the consensus here, CEOs are still quite cautious. I think there's this emerging optimism with regard to the economy, which we'll talk about. That I think there's a pretty broad acknowledgement that the next couple of quarters in the aggregate are going to look a little bit weaker. But then overall, I think there's a little bit more optimism, certainly looking into 2025 than we've seen in quite some time. Now, I haven't talked about this side of it yet. This is the difference between GDP, gross domestic product, and GDI, gross domestic income. And usually these numbers are right on top of each other because empirically they should equal the same thing. But what we see here is a fairly wide divergence in GDP. And so, and these things tend to converge over time. And we've just seen a a period now of quite a few months where we've seen a very fairly unusual divergence, and generally these things will reconverge. And so, as we talk about 5.2%, and that's really strong, we have to put that in the context that it is running ahead of income right now. And usually, if that's the case, then you're going to have one of two things happen. Either incomes are going to go up, and we know wages are fairly sticky, and they've been high, but they've been coming off their peak. So, don't expect an acceleration here. But then the offset is the other thing that could happen is that your economic growth could slow, and we feel like that's going to happen. So you're going to have convergence in the middle of this area, which is going to put yourself, much closer to 2.5% than the 5.2 that we've seen. On this slide, we have the Beige Book Activity Index. This comes to us by way of the Federal Reserve. This is a compilation of data from all the regional Fed districts. You probably recall I show you a lot of data that comes out of regional Fed surveys like the Empire State, Philly, Kansas City, etc. And this is essentially a compilation of that. And we get this data on a fairly rigorous and periodic basis, and I'll tell you right off the bat that it looks a lot like the index of leading economic indicators, just in terms of the ability or the propensity for this type of data to foreshadow recessions. You can see that very clearly defined here, here, and here, and here, and here. Here's the pandemic and the global financial crisis. This data series goes back to the late 70s, and it has a high degree of predictive power. And so where we are now, we're basically into the negative. And if you look at the LEI, which we've shown you a lot recently, I mean, we're 19 straight months of decline in the LEI, and so you can see consistent decline here. I can tell you that in this last data point, the reading, the qualitative information that comes with this data point, basically the indications were that we're witnessing slower economic activity. The labor demand has eased a little bit, so we've seen flat to modest earnings and wage gains, and we've also seen higher retention on the part of employers not willing to necessarily part with labor or lay them off, but they're just not hiring. They're keeping what they have for the time being. We've seen a little bit of, as I mentioned, easing wage pressures. We have seen a bit of subsiding in price increases, and we've also seen some increased price sensitivity in terms of purchasing, maybe a little bit of trading down, if you will. But, this is all consistent with an economy that would, otherwise be slowing down. The rhetoric now is, are we going to have a recession? I think there's building optimism that maybe we can avoid it, or maybe we've seen these rolling recessions in manufacturing, and that was kind of it. But I just want to make sure that we're not forgetting about the predictive power of this particular data series. This is a chart I thought was very interesting out of the Brookings Institute. It is just suggesting that we're going to have fiscal policy contraction. This is what I was talking about in the first slide when we were talking about the outlook for government spending. And so, this is, you have two elements of policy related to money. You've got monetary policy, which the Fed is responsible for, and that's in their domain. They control interest rates, and that helps to influence the supply of money, i.e. inflation, as well as influence the level of employment, which is their dual mandate. And the other side of this is fiscal policy, which is purely in the domain of the federal government and its spending. And so we've had some fairly robust spending, and that has continued, but we feel like the net of all things related to fiscal spending is going to be a drag, if you will, in 2024. This is core PCE, personal consumption expenditures. This is the kind of the rolling averages, if you will. And so I use this, as I have on several occasions, to kind of suggest the rate of deceleration or disinflation that we're experiencing right now. And so, here is the Federal Reserve target at 2%. Again, core PCE is really the Fed's primary bogey, or what they typically look at in terms of how they analyze inflation. So, if you look at the data over the last year, again, this is an annualized number, but over a year, that's basically an annual data point here. We're running, about 3.5, 3.75 maybe. But if you take shorter increments, like 6 months, we're down to about 2.5%. 3 months, we're kind of in the same range. So we're within striking distance. If you look at the near-term data on an annualized basis, then we're pretty close. We're getting a lot closer to the Federal Reserve's 2% target, which should give, some people pause perhaps that yes, this is the end of the monetary policy tightening or interest rate tightening cycle. Obviously we need to watch and make sure that the short-term indicators don't begin to turn back up. But, this should give people some comfort with regard to the pace at which inflation is being managed. Continuing this conversation about PCE before we move on, just wanted to show you the monthly data. So I think it's important to kind of use this as a tool to show the kind of the relative deceleration in this particular data series. So the rapid rise in inflation, and then inflation coming off its peak. So this is the monthly reading. We were up 0.2%, which hit the consensus estimate. Right on the money. You can see, the actual number just ever so slightly below 2.2%, and so they average it up in the data. So you can see a general deceleration, even though we've had a little bit of noise in this particular series over the last couple of months. But the overall trend here clearly is on the downslope. Now we'll talk a little bit about the consumption side of things and get into some other things related to the broader economic health here. This is consumption expenditures on a monthly basis. You can see that data, the survey, the estimate was for 0.1%, and we actually had a little bit stronger data than expected, but the overall trend line is down. You can see that this number does bounce around quite a bit, and there are periods when you get large government transfer payments that number goes up quite a bit, as it did after the pandemic. But we've had some decent data points lately. Again, this is all going to this theory that the consumer is perhaps stronger than we thought it was going to be entering this year, and of course we're about ready to enter a new year. And I think all eyes will be on what these types of numbers do here, looking out into the early part of 2024. Here we have the Consumer Confidence Index from the Conference Board, and you can see that the overall index was a little bit ahead of expectations in the last data reading. And you look over a multitude of years and you can see how this index has done over time. You've got this big dislocation with the pandemic, saw a rapid rise in consumer confidence as we were heading into that pandemic, and you see overall levels are quite lower than they were during that pre-pandemic period. And you can see the general trend line after this, shock and rebound is kind of a little slightly down. So that's concerning to some degree. We want to make sure that, from an economic health standpoint, consumer confidence is very important. Consumer represents 2/3 to 70% of the economy. Good news is here that we've seen a slight uptick when we transition over into present situation. We do see that number continuing to go down a little bit. Present situation, again, itself is below pre-pandemic levels. And, if you look at it a little bit more broadly, it's been trading, or I guess been moving in a band, if you will, not trading. But it is going down. And so that's something that we want to continue to monitor, because that type of present situation kind of assessment in these surveys tends to translate into it tends to correlate pretty well with spending over longer periods of time, and we know spending has actually been pretty well, as we've already seen. So expectations are also important too. Again, below prior year levels right now. It's been kind of moving in kind of a, in kind of the line of best fit would be kind of like this if you go back to 2021. So we definitely hope that expectations are going to pick up over time. On this slide, we have average gasoline prices, which, as you can see here very clearly, are moving down. And after having, gone up for the better part of this entire year, good sign. It puts more money in pocketbooks, makes people feel a little bit better about the situation, tends to help confidence, and also helps to bolster spending in other areas. So continuing on with the consumer, we have inflation-adjusted consumer spending indexed back to the beginning of the pandemic, the onset there. We see here February 2020. And then you can see how quickly goods spending took off. Obviously, we're all isolated. Again, the whole theme was that people ordered Amazon. A lot of things were bought and delivered, goods. Then we had the ensuing supply chain shock, where demand was actually so strong for goods that it overwhelmed the supply chain, and we had all those issues. You can see here, it really took almost until, about the latter half of 2021 before we saw that service number really begin to pick up. And so overall, you can see that this number trending higher. Again, just a general sign of health. Now, say what you will about, what we saw in that last slide about expectations and, how the consumer feels about themselves. But, if you look, especially over a longer term trend line, and then just forget about the noise of the pandemic that influenced consumption expenditures for a period of time, that we've been trending in a fairly linear fashion above that long-term pre-pandemic trend line. So, again, this goes back to the whole notion of the health of the consumer and the reason why this economic slowdown, if it to the extent that it's going to happen, has been delayed, is because of this chart that we've had this continuous level of spending that has been much more encouraging and positive than we would have expected. So on this chart, we have personal savings as a percent of disposable personal income. We know incomes are higher, so even though they're in a little bit of a deceleration, they're still on an aggregate basis pretty high. But here we have, an overall downtrend, as we saw the transfer payments coming out of the pandemic. But, clearly over, the last probably 6 months or so, we've seen a deceleration in savings rates as certainly as a percent of personal income. And on this side, we've got what is termed as excess savings held by U.S. households. And you can see the impact of transfer payments here, and we reached a kind of a pinnacle of well over $2 trillion. And now we're at a point, on a consistent monthly basis, we're drawing that down. And so, the thought is, you've got personal savings that are dropping, you've got this excess savings number, if you will, that's also dropping. And at some point, you'll hit a kind of a terminus, right? You can't go negative in terms of excess savings, but you'll reach a point where, all of the data that we've been talking about with regard to consumer expectations, consumer personal consumption expenditures, and all of that is just naturally going to slow. And I think, this chart is prima facie evidence of that, because at some point you just exhaust your savings, you exhaust your ability to spend out of your resources, and your spending at that point is going to have to come from clearly going to have to come from income. On this chart, we have some data that we received over the week regarding the Thanksgiving holiday weekend. And so on the left-hand side, we've got weekend sales over the years. You can see how that number has kind of picked up over time. Last several years, we've seen a little bit of a gradual uptick. And, of course, this is online shopping during the pandemic year. But the good news is we've seen a kind of a consistent trajectory if you back out that anomaly here, over the last several years. So, I mean, this is all overall online spending between Thanksgiving and Cyber Monday. And so it's good to see that growth here. Now, the rise in sales, when you look at overall sales, and again, this is online spending over here, and then this is retailer spending as defined by Red Book Retail Sales Index. And so, we've had some outsized growth in recent years. Honestly, I'm not terribly concerned at this. I thought 6.3% is relatively good number. It just doesn't look as robust as, maybe 2019, 2020, and 2021 for sure. And then obviously the last 2 years. But, when you go back over, a longer term trend line, 6.3% in terms of a sales number for, the kickoff to the holiday season, that's actually pretty good and kind of sets a positive tone heading into the latter weeks of the year. Something else we're monitoring, obviously, credit quality. Clearly, this is beginning to pick up. It's something that started taking place, really at the end of last year, and we continue to see that move higher. In one light, we're modestly above pre-pandemic levels on both net charge-offs as well as delinquencies, but obviously it's something that needs to be monitored for continued progress. This is one barometer that we use to kind of measure the health of the consumer, and obviously delinquencies will ultimately weigh on the financial sector at some point to the extent that they continue. Now, this is just one aspect of the credit market. Obviously, we've got residential mortgages, which tend to be less flighty in terms of their apt to rise on delinquencies, but we're also monitoring that as well. Something on the positive note here, we see a lot of business formation coming out of the pandemic. And, we remember back in late 2020 and the beginning of 2021, we were talking about, LLC formations and things like that, new business formations for solopreneurs that were starting home businesses and stuff like that really rocketed higher. And this chart kind of indicates that trend has certainly continued, and we see a lot of new business formation. Obviously, a lot of these new businesses will ultimately fail, unfortunately, for those who start them. But a good many of them will continue and prosper and be prolific and eventually perhaps acquire or go acquire other people. But overall, the overall impact on the economy, for new business formation is good. It indicates that you've got a fair degree of confidence in business prospects, and you generally see that number move higher when you come out of economic downturns. Here we have the Baltic Dry Index. This is a measure of shipping. We see freight rates that have been extraordinarily low move a little bit higher. So this is another one of those symptoms of an economy that's actually standing fairly firm globally. But again, I would caution that that there is slowness in various pockets, and we have meandered through a manufacturing recession and so on and so forth. But it is good to see, if you're looking for data points that kind of reinforce this notion that the world economy is actually not that bad, this is certainly one of them. Slide, we have the NAME index, which is the National Association of Active Investment Managers. So this is a measure of professional investors and their optimism level, and you can see here that number has moved higher, and over the last year, you can see it's bounced around a little bit, certainly better than it was last year, and so good to see heading into the last part of the year that institutional investors are feeling relatively positive about the investment market. Looking at the market breadth and its overall health, you can see here in this chart that we've got a higher percentage of S&P 500 members that are trading above their 50-day moving average. In fact, that number is now close to 80%. Not to say that the market is overbought right now, and just really less than about a month and a half ago, it was completely oversold. So we've seen this complete bounce back. Now, I'll caution you that we do see fairly wide swings in this. And if you look at it on a index chart, we have passed through kind of a technical indicator, and that's when you have that 50-day moving average move kind of above the 200-day moving average, and that's generally a fairly bullish signal. And so having most of the index members be trading above their 50-day moving average and moving the overall index moving average above its longer term moving averages is certainly a good sign for the health of the stock market heading into the end of the year. Here we have a chart from Goldman Sachs, really just indicating that we have rarely seen moments like this where there's so much emphasis on momentum, and I think you can see it in the index. With the Magnificent Seven stocks, you can see that this number right here kind of reflects the optimism in those stocks, and we still have an environment where the cap-weighted index is trading at a significant deviation, significantly higher on a relative basis to the equal weighted index. And a lot of that has to do with this. There's so much more emphasis being placed on momentum now. You think about NVIDIA trading at a very rich multiple and moving higher. There's a lot of money chasing that momentum trade right now. We have government bond yields, not too surprisingly, now that we're in kind of a risk on mode, which you just saw in that last chart with momentum trading, that you're going to have a corresponding drop in bond yields. So basically, this is where you see these yields are moving lower, both on the 2-year as well as the 5-year over here. You can see it's fairly consistent chart. Again, at some point you'll get some moderation through monetary policy. This is clearly a market that is overall, with these kinds of drops, expecting rates to go down over the coming months, and I do think that they will come down at some point, especially if we have that drop in consumer spending. May not be as much as people are thinking about, and it may not come as soon as people expect it, which I think would be a volatility-inducing surprise to the market. But the bond market does a really good job of foreshadowing. I think in many respects, a much better job than the equity market does on future conditions within the markets. And I think here we're looking at something that, over the next 6 months that we could be looking at perhaps, 1 to 2 rate cuts overall. Here we have a global EPS, global earnings per share. We can see here, just like in the U.S., we've had some moderation in that. If you look in isolation to this point right here, this is actually a forecast that EPS growth looking into 2024 on a global basis is actually looking up a little bit. So, 2023 overall, not as much, even though the relative valuations for international stocks have been quite attractive relative to domestic stocks, and we've actually seen some pretty good performance out of international markets. But we are kind of looking into the next year, kind of expecting reasonable performance from global companies insofar as their earnings are concerned. Now, we're also looking for positive growth in U.S. Domiciled companies as well. But I do think the risk is that maybe, that things are a little bit too optimistic, especially if you get consumer spending slowing down, which will influence U.S. Profitability and earnings. Global markets are maybe a little less tied to consumer spending than we are. But nevertheless, it is optimistic to see at least estimates remain positive for next year. The question is, how positive are they going to be? Here's a chart that kind of defines the opportunity longer term in emerging markets. So here we have emerging market equities versus US equities. They are currently trading at 50-year lows. And this is again, this is a rare development. So this data series goes back to, basically after World War II. And you can see that, that we actually haven't seen an environment like this, as this would indicate, in well over 50 years. And so, this begs for investment in emerging markets. And of course, right now, China is technically attached to that basket. And China has, I think its fair share of problems. And we actually have a chart or two. And I'm trying to, in this pack, I'm trying to include some on China, going forward, just dribbling on incremental data. But if you back out of China, or if you back out China from the conversation, I mean, the rest of the emerging market index is very, very cheap, not only in the aggregate, but also on a relative basis. It's just waiting for that catalyst. And we're going to conclude today on China. So here we have the Manufacturing Purchasing Managers Index. This is official government statistic. You can see that the number was estimated to be below 50, which indicates contraction, and in fact it was. So here we have a Chinese economy that, with rare exception, over the last 2 to 3 years has been trending lower. We know that some of this has been induced by COVID-related shutdowns, but now that those are kind of in the rearview mirror, all eyes are on the open economy for China, and we know that it is currently struggling right now. So that does, tying back to that last chart, tie in a little bit to the weakness that we're seeing in emerging markets relative to U.S. markets. But I think it just indicates that China is going through a bit of a catharsis right now. It's kind of reaching a new level of its evolution as an economy, and the law of large numbers is finally kind of catching up to it. And there's also been a lot of bad policy decisions on the part of the Chinese government, and we see that manifest already in the real estate sector, both the residential and commercial real estate sector, and certainly in the banking sector, where China is now essentially cut off the flow of information on underperforming loans or delinquent loans and what have you. So we really don't know how unhealthy the banking sector in China is, but we just know that there are problems that need to be monitored over time. That will do it for this week. I hope you have a wonderful week, and look forward to talking to you again soon.